Hello and welcome to another quick webinar here at FCI Markets. My name is Justin Paolini and today we're going to talk about the US presidential elections. Before we start, please read the risk warning. Our investment products and services are not suitable for everyone. It is possible to lose all or part of your investment. For leveraged products trading, it is possible to lose more than your initial deposit. Trading on margin carries a higher level of risk and it is possible to be required to deposit additional funds. You should not invest money you cannot afford to lose. And with that said and done, as usual, our objective here at FCI Markets is to give you the tools to be a consistent trader, to help you simplify your trading habits so that you can come on board, get funded, and become a professional foreign exchange trader, either coming to our desks in our offices or trading remotely. If you want to check out the funding opportunities that we have, then please go to fci-markets.co.uk/funding, and you can also register your interest. If instead you're just starting out, go over and find our free course where we have condensed 15 years of trading experience into 12 concise lessons. And finally, if you're really serious about taking the short cut up the learning curve, then come on over to our academy. You also have the possibility to receive a funded account not too long after you graduate from the course. So with that said and done, let's get on to the US presidential elections. What is important to know about these elections? Well, the first thing is that the elections are won by the first candidate to reach 270 votes. So the first over the line wins. However, when looking at the maps of how the states are divided, it would seem that there is a predominance of Republican states. However, what we need to know about the states in this election is that each state has a number of districts that are dependent on population density. So in reality, as we can see, most of the states that have a Trump majority actually have a very small population density. And the states that are forecasted to show a Biden win have many more districts. So this means that in reality, Biden is favored on paper right now to win. There are still a few states that are the battleground states that still don't have a clear majority. But this is how the market is positioned. The market right now is positioned for a Biden win, and Trump is struggling. The other thing that we need to remember, though, is that it's not just the overall winner that matters, it's also who takes the Senate. Each state has 2 Senate seats up for grabs, and right now the Senate is Republican, but the Democrats are only 4 seats away from achieving a majority. So in reality, this race is closer than many would expect. The current odds, if we're talking about betting odds from Real Clear Politics here, betting odds are obviously favoring a Biden win, and they have been for quite a long time. However, if you look at these odds, they're slightly reminiscent of something we've already seen. These were the odds back into the 2016 election when Hillary Clinton was still favored to win over Donald Trump, and the percentages were approximately the same. There was more volatility, of course, in the race, and right now Biden would appear to have more momentum behind him compared to Donald Trump, but that too has been changing in the past few days. So I guess what I'm saying is, don't trust the consensus. Just understand what the consensus is, because that way you know how the market is positioned and you know what will upset the market the most. This is showing you the Senate. There are Senate seats up for re-election, and the Democrats only need 4 seats to win in the Senate as well. and the Democrats are expected to win the Senate, but the race is tight. Okay, so don't trust the consensus as much as the odds would suggest that you do. So what does this all mean? What are the four scenarios to consider, given these maps and given the probabilities? The market is betting on a Biden win and on a blue wave. So the blue wave is Biden winning, becoming president, and also taking control of the Senate. Okay, this should be positive for stocks and negative for the dollar in the short run. So it should be a risk-on move in the short run. However, in the longer term, okay, Biden has talked about coming down hard on big tech. He's also talked about raising corporate taxes and raising taxes on the wealthy. So in the longer term, there may be some downwards pressure on stocks, but for the immediate future, the markets would definitely reward the lack of uncertainty, and the markets would reward clarity on a clear Biden win. The second scenario is a divided government. So there isn't a large probability on this happening. Some analysts suggest around 20%. And in this case, Biden would win presidency, but Congress would be split. Okay, and in this case, it would be tougher for Biden to to make law, to promote his policies, and there'd be a bit more uncertainty. So there would be a bit more indecision, maybe a slight positive given the Biden win, and in the short term, stocks would be slightly positive, the dollar slightly down, and long term, approximately no change. Now let's get into the more interesting scenarios, which I believe the market is not pricing accurately, because this is the risk. The risk is that we have either a red wave or a contested or delayed election outcome. The market is not expecting Donald Trump to win. Okay, and even if the market is not expecting this, it doesn't mean that we would go directly in the opposite direction. It's true that a Donald Trump win wouldn't necessarily be a green light for additional spending, for stimulus. So most analysts expect a Trump win to actually be a bit negative for risk. And they're pricing in, continued U.S. and China tension and continued uncertainty over stimulus packages. Whether this is correct or not right now isn't the question. The most important thing here is that the market is not expecting a red wave. But personally, and this is just my personal view, if there were a red wave, so Donald Trump confirms his presidency and he controls Congress, I think the market would reward that kind of clarity just as much or almost as much as a clear blue wave, because the markets don't like uncertainty. So I don't think the analysts are understanding this or pricing this in correctly. The market certainly is not pricing this in. And then the worst outcome would be a contested election or delayed election outcome. Okay, this could take many different paths. It could involve the U.S. Supreme Court as well. If you remember Al Gore and George Bush Jr. back in the year 2000, there was a contested vote count in Florida, and it took up to 1 month to actually understand who the winner was. So this would drag on the uncertainty, and this would be a big negative for risk, and the dollar and also the yen would probably benefit from the risk-off scenario. The market, of course, is not considering this. It's not considering the red wave. So these are the two scenarios that would most upset the market and would most surprise the market. It would probably generate the biggest reactions from the market, one way or the other. So these are the things that we need to pay attention to. And the blue wave is basically status quo. The market has already priced that in. There wouldn't be too much of a surprise if that were to happen. Okay, so these are the four scenarios. These are the less probable scenarios, and so these are the scenarios that would generate the biggest moves, the most volatility, because the market simply is not pricing them in. A blue wave, yes, it would be positive for risk in the short term. Stocks up, dollar down, but not that much because the market has already priced it in. One other thing I'd like to add is, there is more complexity to this, and a reason why I think the odds are different than what you see on your screens and what you see in the mainstream media is that mail-in ballots are complicating the picture, especially due to the record voter turnout. Um, Counting the mail-in ballots is a complex procedure. It's possibly outdated, but it complicates this whole picture. There could be possible delays, to the results just because of this. And also, there have been some reports of voter fraud, of people going to vote and finding out that their vote had already been registered. So, there are some gray areas here, and this just creates more uncertainty. Now, if we look at what the market is pricing in, even though the market is pricing in a Biden win, the market is also pricing in heightened uncertainty all the way into December, and past December. Okay, for the whole month of November, for the whole month of December, volatility is expected to remain elevated. Okay, and then it declines a little bit into the new year. January is still elevated, and February it starts to drop. So what this is telling you, okay, these are the VIX futures, and this is telling you that the market is actually bracing itself for potentially an undecided election or a contested election. It's showing, more uncertainty than the polls or the odds would have you believe. So it's just something to keep in mind. So what's the play? First and foremost, okay, don't trade ahead of the election. Don't trade today. Don't trade tomorrow. Okay, and don't trade during the night of the election as the votes are coming out. Okay, there is no rush to risk your hard-earned money in these volatile markets. Okay, this will be a close call, and the odds just do not favor betting in the midst of the storm. There will be clearer opportunities as the picture becomes clearer in the coming days. And if you remember, in 2016, we had a rally that lasted months. Okay, so the moves that happen once the election is over will last for a while. So there is no need to jump in the midst of the storm. The other thing is that, of course, markets are priced for a Biden win, so you understand that, a red wave or a Trump win or a contested election, those are the things that will significantly spike volatility and create havoc in the markets. They'll create, the strongest reactions. I do believe, also, not just because of the VIX curve, but I think volatility will remain high after the elections. This is, the most influential event of the year. So it is logical to expect heightened volatility in the coming days. Now, what this means is that your positions need to be kept smaller because the swings are going to be larger. Okay, the average daily ranges are going to expand, and this means that if you were trading up to now, for example, with 20 pip stops, you might have to adjust it. You might have to double it. You might have to, use a different stop loss procedure because you need to take into consideration the volatility of the market. Also, the markets will be volatile not just from a technical standpoint, but also because there will be a lot of headlines coming out. So headline trading means that continuation trades, so a trade that you just enter and it just keeps going and going and going in a nice trending fashion, they might not be seen for a while because over the coming weeks there will be a lot of headlines coming out, and this means that intraday positions and intraday trading might be a better stance than betting for the longer term. Until all this passes. And finally, I'd just like to suggest that you don't try to be a hero. Don't bet the house. Don't try and go for the big winner. Live to fight another day. Trading is another form of gambling. So you need to have clear risk limits. You need to have a clear position sizing algorithm to help you. And you need to remember that, you know, you can continue playing and you can make back any losses as long as you still have chips on the table. If you lose all your chips, you're out of the game. So, rather than do something, rash, or rather than try and, swing for the home runs, perhaps be more conservative with your risk capital. Okay, there will always be another opportunity. Okay, you can let other people just battle it out or grind it out, throughout these volatile times. But please know that professional traders are more patient, and they think twice or three times before risking money in the markets. So I would suggest that you take on board these suggestions, because patience, selectivity, and not risking your hard-earned money in a rash manner pays over the long term. Now, these tips and the scenarios that we talked about, these are important to know, because if you understand what consensus is, you understand what is priced in, you understand how the market could move if it's surprised. And that's the thing that really matters. It's not a matter of being right or wrong. It's a matter of understanding what is priced into the market and what would create the biggest move, and what would surprise the markets the most. That's what is most important, and that will help you understand where the better opportunities will lay after the elections and depending on what happens. So I hope this was useful, and as usual, if you do need guidance, then come on over, subscribe to our thought leadership. Just insert your email into the little box here, and you'll receive our morning calls, weekly calls, webinar emails, thought leadership pieces directly into your inbox. And also, you can come and get our free course if you're just starting out, or you're not too sure about how to approach the markets. Then come on over to fci-markets.co.uk/promotion/free course. Or you can come over to our academy at fci-markets.co.uk/academy. And this is the shortcut up the learning curve. Finally, you can follow our Twitter account at FCI Ltd UK, and we put only the most influential market moving news in here, as well as key charts, or the most interesting charts that we've selected. And finally, if you have any questions at all, just write to us at client.support@fci-markets.co.uk or give us a call. We're happy to hear from you, and we're here to help you. This is Justin Paolini for FCI Markets. Over and out.